Hey, and welcome to the rareliquid podcast. Today, I'm speaking with Annanay, who graduated from the University of Cambridge before becoming a quant trader at various firms, including Flow Traders and Tower Research Capital. He's now working on his own company, an exchange called QFEX, which successfully went through Y Combinator. A lot of you have requested an interview with quant traders and high-frequency trading, and Annanay provides a ton of great insight into the industry that very few actually speak publicly about. So I hope you all enjoy this episode. One thing we discuss in this episode is the impact of AI in quant trading and the investing world as a whole. And as you probably know, being able to leverage AI is quickly becoming the most in-demand skill sought by the world's top employers, but it's often hard to know how to actually build these skills. This is where a recently announced certification program from Columbia Business School and Wall Street Prep comes in, and it's focused on AI for business and finance. Throughout this 8-week-long program, you'll learn about core AI concepts like LLMs and machine learning, get hands-on experience using Python to solve business problems, and see how top firms use AI in FP&A, risk, investment management, and more. You'll be taught by world-class Columbia professors and also have a chance to learn from a ton of great guest speakers who work at firms like Perplexity, OpenAI, and Google. There's truly no program currently like this that has a combination of both AI and finance. And so if you're interested, be sure to use my code rareliquid to get $500 off. And I'll leave information for everything I just discussed in this video's description. Annanay, thanks so much for joining. And I think we can just get straight into it. It'd be great if you could first give us an overview of your background.
Yeah, thanks for having me, Ben. I'm a mathematician. I grew up in the UK and I went to Cambridge, studied maths there for 4 years, mostly doing like theoretical physics and quantum computing by the end of it. So the maths behind like standard model and things like that. Around that time, I had a PhD offer and I was like, I'm going to try working in industry for a bit. And then I never looked back, basically. So I went to a quantitative HFT firm called Flow Traders in Amsterdam for a year and a bit. And then I moved to Tower Research Capital, which is an American HFT firm based in New York and, it's global already. And I was in their London office for a number of years. And then I left this year to build an idea I had when I was working at Tower called QFEX, which we'll talk about later, which is basically the first 24/7 perps or perpetual futures exchange on traditional assets like equities.
And how did you decide that trading was for you?
Yeah, I guess like I ended up studying maths, right? And then in the UK, or coming out of Cambridge, it was like very obvious that trading was like a very lucrative career. In those days, it was a lot more secretive than it is now. I think like the cat's kind of out of the bag with how much money Jane Street are making and paying to their first years and so on. Back in those days, it was a little bit more underground. Like even at Cambridge, if you kind of told someone you were going to a firm, an HFT firm, they wouldn't really know what you were talking about. But yeah, I mean, for a mathematician, it's like a very interesting role, right? So it's a combination of like math, statistics, game theory. I was playing a lot of poker. It's competitive, involves like thinking about markets and yeah, I just like the competitive aspect of it, to be honest. So I knew I could thrive in that like high pressure environment. And a lot of my peer group was going and like, it was like very lucrative. So that's basically how I ended up there. I did an internship. I really liked it and then decided to go on for full time.
A lot of questions I have based on what you said there. But first, I guess if I was in your shoes and I had to recruit for this, I guess it was a little less secretive now than it was back then. But how did you even go about like preparing for the interviews?
Yeah, so the interviews are like kind of infamous for just being like very brain teaser heavy. You don't really get questions like, hey, can you tell me about a time you worked well on a team? I think those questions are like super easy to prepare for. So you're just testing like, did somebody rehearse an answer? These ones are a little harder, but like preparation is important, obviously, because it's still competitive. You still got to do better than everyone else, right? So in those days, it was like, the preparation materials weren't as well known, but basically because it was like still in the UK at least, this like silo from Cambridge maths going to these trading firms, we just kind of prepared by asking people like who were in the years above, like what kind of questions they got asked, preparing question banks, and to be honest, like a lot of the coursework we were doing was very like puzzle oriented. And I think they kind of designed the questions like that as well because they want people who naturally enjoy solving these kinds of puzzles and would go out and seek them anyway. And yeah, that's like the kind of person they're trying to attract. So they want to make it as easy as possible for that kind of person to come in and not like some like business major like scrub who spends all their time preparing. Now, obviously, there's like resources. So there's these two very famous books, Heard on the Street and Practical Guide to Quant Finance Interviews, that have like question banks. Those ones are a little overused now. I actually posted a few of my favorite ones I used to use at Tower on the internet a few days ago, and they had like quite a lot of views. But yeah, the key thing is just like to like not wilt under pressure. So like be able to answer these in like a timed way. I feel like most of the questions aren't actually very hard if you're doing them not under stress, but then it's like, oh, I have a 500K job on the line. If I answer this math problem, that's when your brain stops thinking, basically.
Got it. And you said you posted on the internet, like did you post on like Twitter or something or LinkedIn?
Yeah,
or?
Twitter and LinkedIn. LinkedIn had like a lot of reactions. Twitter as well. Yeah.
What's your Twitter handle for people to follow?
It's A_Kapila_ KAPILA.
Okay, I'll add a link to it later, but or in the video's description. But you also mentioned that the work was very competitive, and so I mean, I actually remember one of my friends back in college was working at an Optiver for a summer, and it was like something like trading related, and then he was like a really smart guy, and he ended up not getting a return because like. Unlike a lot of other places where you get a summer internship and then most people get a return, it seemed like there a very few number of people did because they just like hire some people and they know they're going to cut like a majority of them. Like, did you find that was the case as well for you? And was it like extremely competitive once you got into the internship and full time, or was there a little bit also more like working together type of collaboration?
Yeah, I think different firms do in different ways. Optiva is like pretty famous. That one example you pulled out for like having a very wide funnel that like narrows very quickly. I think, we'll dig into this a little bit more, but there's like two breeds of quant or prop trading firms, right? There's like the technologist breed, like Hudson River, Jump, and then there's like the ones that came from, let's say, old school like pit trading companies that realized that they had to like upgrade their tech. So Optiva, SIG, even Jane Street. Jane Street has a lot of very smart people, but even Jane Street has that kind of like culture, and that's where it came from. Those are the ones that tend to emphasize, being competitive, being aggressive, and they value that in their employees more. Where I was at for most of my career, Tower was not like that at all. It was actually like very collaborative, but collaborative within teams. I think all traders by nature are like somewhat competitive though, because like the very nature of trading, it's very different to other businesses. It's like not super value creating. Actually, like basically every time you deploy a new trading strategy, particularly if it's like a high frequency trading strategy, you make the market a bit more efficient. So everyone is like competing for this fixed pie. There's very little like growth of the pie, or there's very little growth of the pie that you can do. You're always competing for the same P&L share, and you're just trying to maximize your P&L share against all the other market makers. So by definition, it's like a very cutthroat and competitive business, I would say. And even harder so because the people you're competing against sometimes are like the smartest people in the world, right? Like IMO medalists and went to the top schools and so on. So you have to be like willing to put yourself in that, both work very hard, but also just like be very smart and very competitive.
When it comes to the aspect you mentioned of not creating value, like, is that something that got to you? And as you saw a lot of people leave the industry, is that something that kind of got to you? And then also like if you had to look at your people who are really high up and really senior traders, like, do you think they're just okay with that? Or does that also still affect them?
Yeah, pretty much. I think they're just okay with it. Like, there's very few people who try and claim that like high frequency trading in particular adds any value. It is more or less speculative value extraction from the industry. There's all these like arguments that they're basically doing liquidity provision, which enables transactions to happen at lower spreads and so on. But if you actually go inside any of these trading firms, like no one is really thinking like that. No one's thinking like, how can we make the market more efficient and make trading cheaper for our clients? The beauty of the market, right, and this is like pure Adam Smith's economics, is if you incentivize a load of market makers to all try and make as much money as possible by competing. I'm talking about market making specifically here, but a similar argument works for like all kinds of systematic trading strategies. If you incentivize them to just make as much money as possible, and they compete with each other for it, the end user gets the best outcome, right? So you get like liquid and low transaction cost marketplaces. But that's not how anyone in these firms is really thinking. And the marginal effect is very low, right? Like if one trading firm suddenly stopped trading, it would have barely any impact whatsoever on like the end liquidity of the market. So joining, if I just sum it up, like joining trading, like don't be under the assumption that you're like out here making the world a better and fairer place. Market makers are needed to some extent, but like not to the extent that it's got to. At this point, it's like pretty much value extraction. And I think people in the industry are like pretty much fine with that, right? Like,
Yeah.
Even so, like Jane Street, for example, is a very big link with effective altruism, which was like huge before SBF kind of put a shadow over the whole movement. And even EA, who was very tied to Jane Street, even their take on the whole industry was like, it's probably not net negative, but you can make so much money that if you like donate a portion of your income to charity from it, then you can do good in the world. But you have to go through that hoop, right? It's not like a net positive value creating industry.
Is that a conversation a lot of you guys would have? Like, oh, we're making so much money and maybe we should donate or so we can add value to society or something? Is like, or is that something a lot of traders think about? Because I imagine a lot of people are in it because they want to make the money and keep it a lot more for themselves.
Yeah, pretty much. Yeah, that's pretty much right. At least at the firms I worked at, like no one used to think like that.
Okay, got it. And then I wanted to ask a little bit about your day in the life. So if you could walk us through, I'm sure maybe like a lot of days may be different, but if you could just walk us through like what you think was like a standard day in the life for you as you were working.
Yeah, so it's really interesting because a lot of people, especially entering the industry, don't realize how different the different firms are. But broadly speaking, there's two things a quant trader has to do. And the title like really means different things at different companies. So I'm just going to call them quants for now, but some firms call them traders, some call them quant traders, some call them quant strategists, whatever. There's really two things you have to do. One is like systematic improvements to the trading strategies. So that involves researching the current trading strategies, where they're not doing so well, where we can improve them, coming up with ways to improve them, testing them, deploying them. And then the other one is like monetization. So it's like basically we have some set of trading strategies, some alpha, some way to beat the market, right? How do we extract as much money from that as possible? So it's like strategy and tactics, right? The latter one is like a lot more short-term thinking, a lot more, what do we deploy? When do we deploy it? Where is the market going to be? Would this kind of strategy work well in this market? If I know the price of something is going up, do I want to buy passively? Do I want to buy aggressively? How much do I want to size it? And yeah, just like working generally much closer to the P&L and making sure you're extracting as much P&L as possible. And then the former is kind of like thinking about long-term improvements to, how can I predict the market better? Or how can I get my orders in a little bit faster? So some firms like split up these two roles. Most firms, these roles are kind of done by the same person, but depending on how systematic the firm is, the percentage of time, or even how systematic the desk or that team is, the percentage of time that they spend doing one of these two different roles will vary. So when I was at Tower, I probably spent like
So
when I was at Tower, I probably spent like 70 to 80% of my time making long-term systematic improvements to our models, which was mostly due to statistical research, and the rest of the time like monitoring what was already trading, seeing like, oh, this is losing money, like why is that happening, like turning stuff on and off because I knew something special was happening that day. And my first job, it was probably like reverse actually. So I spent most of the time, because the markets were like quite different, I spent most of the time making adjustments during the day, and I only had like a very small amount of time left to make like systematic long-term improvements.
Which one did you enjoy more?
I probably enjoy like the short term, like, when the market's moving like crazy, a lot of times like models just like don't work because they're trained on different market characteristics. You can like obviously adjust them and do all this. You can try and think about it, but at the end of the day, if like a black swan happened, right, like, and you're using a completely systematic trading strategy, the systematic trade strategy won't be able to learn out of sample what to do in this situation. So that's when you really have to think on your feet, and that's where you can have an edge as a human. However, doing that day in, day out, 24/7 is exhausting. So like definitely kind of longer term stuff, making like a tweak to a model so it makes more money most of the time. That is definitely more satisfying and more sustainable long term, if that makes sense. So I enjoy the former as long as it was like here and there, not all the time, and then otherwise the latter, yeah.
Yeah, I mean, that makes me think about my roommate who's like very heavily into retail trading and options, and he thinks a lot about like the different types of strategies as well that he wants to do. But then I'm sure he gets the most excitement when these companies have like random events that move the stock a lot, and he just crushes it for that day, basically. But on that note, it would be, I think, really interesting to hear about some of the best or worst trades that you've seen, either from like yourself or from any colleagues, like what the situation was and what the kind of strategy was and how it was able to like bring like potential X percent or returns or something like that, if numbers can be shared.
Yeah, sure. I can definitely share some numbers. I would say like, so in terms of like individual trades, at my last firm, we didn't really do, everything was like pretty much systematic, right? So we didn't really do individual trades. The first job I worked at, we definitely had some discretionary type trading. Definitely the biggest one I ever did was we set up like a new desk to trade altcoins, and market was like very inefficient in those days. So we're talking crypto markets here, like late 21, early 22, or even like mid 21. Actually, that was like basically peak inefficiency, and you would just see crazy things happening. Like on FTX at one point, they had Doge USDT and Doge USD, right? So one is against like fiat dollars and one against tether dollars. And once they just randomly trade out of line by like 50%, and no one really knew why. And we were just able to arb them basically back in line. That probably made around like 500-600K, I think. And then we had like an even crazier one, which is like there was a coin that was trading on Coinbase and Binance. It was newly listed. And then Coinbase messed something up, and I won't go into the details of that. That's a little bit alpha sensitive, but basically started trading at a big discount compared to Binance. And that was very, I mean, it was like, I think like a 60% discount or something. And then it was kind of tough because if we tried to arb it, we actually couldn't hedge it immediately. We didn't know when we would be able to hedge it. So basically we had to, we could buy it in Coinbase for a 60% discount, but we didn't know when we could sell it again at the higher price. So we basically made a call like, okay, this is how much risk we're prepared to do. And then we did it. And then the coin actually went up by itself. So we made money on the coin just going up. We got unhedged. I think we made like 3 million in a few hours on one trade. Which is pretty exciting. And we had like almost no capital on that desk to trade with. So it was like, probably put like 500K into the trade or something. So it was like literally like a 6x return. Not all like completely arbitrage based. Like it was slightly directional as well, but not a bad day's work for sure.
Yeah. Did you guys have a lot of risk control such that if you're to minimize losses to a certain amount, or, you know, you had these crazy days where it can go up 500 to a few mil in one day? Were there times where you guys didn't have proper risk controls where you guys had similar losses in a day as well?
Yeah. I mean, so the difference between having big ups and downs and having poor risk controls, I would say everywhere I worked, I had very good risk controls. But you can also have strategies. You know, I know a firm, I'm not going to mention them by name. They have a team of 10 guys who make like $1 billion a year, and their Sharpe is like just over 1, right? So every day they're like plus or minus like $50 million or something. But they've done the statistical research, and they've like figured out that they do have edge systematically. And they've also figured out actually that they could just do the trade for less money and have like a higher Sharpe. So like higher, basically lower volatility in their returns. But they were like, you know, we know we have edge. Like we may as well just size it as big as possible. We don't mind like being down 50 million, down 100 million some days. As long as you're like confident, you have that prior that you have some edge, you've beaten the market in some way. So they made like $1 billion a year. Now that's not bad risk control. That's actually very good risk control, because it's much harder to risk control a strategy which you don't know if it's going to have to make money every day, and to size it up and do it at big scale, than it is to like work with a strategy which like pretty much makes some arbitrage strategy that pretty much makes money every day, and like you don't really care. Basically, if it starts losing money in a few days, you'll just like turn it off, and like you won't have lost that much money, and like you don't have to think too deeply about it. So basically everywhere has good risk controls. Firms that don't have good risk controls tend to blow up very quickly, like Alameda did, for example. And having a very up and down swingy P&L is actually, in a firm that's existed for a long time, is actually a sign of good risk controls. Because in order to operate a firm like that with a strategy that goes up and down a lot, you need to know what you're doing, like even more.
Got it. Okay. I guess that might be somewhat similar to having faith in your like if I were to distill it to an analogy for retail investing, it's like if you have a lot of faith in a company stock that you purchase and it goes up and down over time, that's better than if you're like just buying stocks and selling it when it's up, and then if it's like down a little bit, just selling it right away, right? Because that means you're probably going to sell at the wrong time, miss upside and stuff like that. That makes sense.
Exactly. It's a very good point you made about selling at the wrong time, right? Like, actually, you're overwhelmingly likely to sell at the wrong time if you don't have confidence in your methods, right? Because like, it's like say you put in an order to buy something, and like it gets filled, you put a stop loss just below, right? Even if your trade was like the best trade in the world and the stock pretty much just goes up, if it just goes down a little bit, you're going to lose money. So you're almost certainly going to lose money, right, on that trade. And it's like a small amount, but you will lose. So yeah, that's why, like, especially for retail investing, right, it's important not to be emotionally driven. That's like why systematic investing like works so well, and systematic trading works so well, is like it removes some of those human biases. And yeah, you need to have a good thesis. Like your thesis cannot be like, oh, if the stock, basically if you're buying a stock, like for a retail investor, you have to think, if this stock dropped 20%, would I want to buy more because it's cheaper, or would I want to sell because I no longer believe in my thesis? And if the answer is the latter, like don't even enter the trade, because stock investing, like even very good hedge funds who do this, like they work like 90 hours a week, like Citadel, and they do like stock trading, like fundamental stock trading, like their Sharpe ratio, if you're kind of if the listeners know what that is, like very rarely above like 3. That's like a very good Sharpe ratio in like the equities world. And with a Sharpe of 3, like you're not that much more than like, it's not like, oh, by end of year you're like definitely going to have made money, right? It's like, it's actually very low probability that you'll not very low, but like not guaranteed that you're going to make money over like a year. So those guys at these hedge funds, if they enter into a trade and the stock goes down a lot, they have enough conviction to like size up more, right? And that's where you have to be mindset wise if you want to play stocks, because stocks is like very, very tough game, and they're very volatile.
Do you also personally invest in stocks?
Yeah,
or?
Yeah.
And then do you do a lot of trading, or is it more fundamental?
So yeah, I used to do a lot more trading. I have less time now because I'm obviously founding a new startup. Actually, I mean, that's the reason I left my first job, is like I started running some trading strategies on my own, and I was like quickly making more money doing that than like working at my job. So I was like, okay, I'll just leave. Yeah, I mean, like I used to do a lot of crypto, both discretionary and systematic. To have like real edge, and we'll talk about edge I think later, but like to have real edge, you really need to be deeply involved, I think, in the community, or think, like understand how an exchange works very well, or like understand what like the new narratives are emerging like very well. So as like the amount of time I had like decreased, now I just kind of do passive investing. But yeah, if I had more time, I would definitely do it. I have to see like where my time is best spent, basically.
Yeah, and before we go a little bit more into kind of like, as you mentioned, the edge and like investing and all that, I did want to ask a little bit more about what kind of like tools and platforms and stuff like that you're using. Like when I really want us to be able to like paint a picture of you're like going to your desk and you're like, sounds like maybe building statistical models, but like what are you building that on, and what does that kind of look like?
At work, you mean?
Yeah.
Like at my job.
Like,
yeah. So we had like everything in-house for monitoring the trading strategies. Like we would have basically like a dashboard that told us like, hey, these are the trading strategies they're running. They're parameterized. So it's like there's like one parameter that controls how aggressive the strategy is, right? So if you set it more aggressive, it'll do more volume and more trades, but it will take less edge on the trade. So it's like it's if you want to think about it in layman's terms, it's like how many cents do I want to make on every dollar that I trade, right? So to give you an idea, like set expectations in the high frequency trading world, okay, 0.01 cents on every dollar you trade is pretty good, right? If you can run a high frequency trading strategy that makes 0.01 cents roughly per dollar it trades, that's like pretty good. So we would basically have a dashboard that has all these parameters, and like it would basically tell you how well the strategies are doing, and things that you can adjust, like this aggressiveness factor that I just told you. How many cents do I want to make on every dollar I trade? Now, if you set that to give you an example, like say the strategy is losing money, and you think, oh, actually, it's asking for 0.01 cents. I'm going to call that 1 bip from now on, by the way. That's the industry term, 1 basis point. If it's asking for 1 bip, but it's actually losing 1 bip, you're like, oh, actually, the model isn't calibrated very well. I'm actually going to ask for more edge because I don't want to lose money. If I ask for 1 bip, it's actually losing 1 bip on every dollar it trades. But if I ask for too much edge, it won't find enough opportunities to trade on because there's not that many opportunities where like I think it's going to make a lot of money per dollar it trades. So we'd have things like this. There are other factors and other parameters you can set. We would basically have like a dashboard with all the parameters. That would always be up, depending again on how systematic the strategies are. So in my last job, like I barely had to touch these. I would touch them like occasionally, like not like super often. In my first job, I would touch them quite a lot. Basically, like you couldn't like leave the desk. Basically, you would like have to make sure somebody's there and like able to change them quickly. And then, yeah, like when the market is quiet, like these parameters don't need changing much, or my second job, they wouldn't need changing much anyway. I would basically work on improving the models. So you asked for tools. Basically, we had hypotheses of how the market should behave in certain conditions, which were rooted in like microeconomic reality, and we could basically turn those into we can basically turn those into equations, right? So I'll give you an example. It's like a very simple one. If I look into a market, I can look at the total amount of quantity that people want to buy for and divide that by the total amount of quantity that people want to sell for, right? So there's the orders to buy are called bids, orders to sell called offers. I take the total number of bids and add up all the quantity in those and divide by number of offers. And that's called order book imbalance, right? So it's like how many more buyers are there than sellers? What's that ratio of buyers to sellers? So that's like one example of like an indicator that says where the market's moving. And then we can come up with more of these, or we can like try and tweak them, and we would have ideas of like, okay, this one's not working very well anymore, and we would basically try and come up with new ones. And like we have like various statistical techniques that I would run with Python to see like which ones work well, which ones don't, which existing ones aren't working well, and then I would use them to kind of back test and create predictions on, hey, if I had this model a month ago and I asked it to predict me the price of something like 10 seconds ahead, how well would it have done? And then there's like a lot of statistics you have to do to make sure that the model like generalizes well, so it works well in scenarios that it hasn't seen. Basically, we'll be working on stuff like that. And if we found some improvement to our pipeline for making models, I would just basically make it part of like our generic model making framework. There were other things as well. So like I'll give you some examples, like how much size are we trying to trade for? Is there a systematic way of figuring out if I want to trade with this signal on this market, if I trade too much size, I'll probably lose money. And if I trade too little size, I won't make as much money as I could have. They're a good way to figure out how much size we need to put. Or some strategies really depend on latency. So like basically how fast can I place orders into the market, right? Some strategies like really depend on this. So we would monitor how fast our strategies were able to place orders into the market, and always be thinking of ways to make them faster, either by kind of hacking the exchange a little bit, improving the quality and performance of our code, upgrading our own systems, and monitor any time that like there was a decay in how fast we were able to do it. Like, is that because we did something wrong? Has the exchange changed? Can we ask the exchange? So those are kind of the things that you end up working on, basically, like price prediction, like trading, ordering, order sizing, things like this, and then kind of like the tech side, like latency, that kind of stuff.
Mm.
So yeah, and there's
So
always just like there's a huge list of things to work on. So like the projects are never ending basically, but we were doing them like all the time, pretty much.
got it. Okay. So you had to also be good at coding in addition to statistics. And then was there a lot of math involved as well, or not really at that point?
Yeah, I mean, like math, statistics, like there's no pure math. Like, you don't need to know what like group theory is and stuff, right? Like, it was like, there's a reason like a lot of physicists go into finance, and it's because there's a lot of like very noisy systems, so you end up like creating toy models in your head for like how the markets work, and then like trying to encode them in statistics. But yeah, I would say those are the core skills that you need to. They're like what a mathematician would call necessary but not sufficient conditions. So you definitely should be good at coding, or like at least be able to code simple things yourself. If not, like be like some firms you almost have to be like as good as a software engineer. But even at like not great firms, you have to be able to code a bit, like some Python, some data analysis. You have to understand basic statistics, and sometimes advanced statistics. Usually not to the level of like really advanced techniques. It's more like understanding how to set up experiments properly, understanding like correlation versus causation, understanding hidden variables, and part of that is understanding how markets work, right? So it's like trying to give an example that won't leak a lot of alpha, but it's like it's a bit long-winded. To be honest, to do statistics properly, you like need to understand how markets work as well, and like interweave that. And then math, like some companies ask mental math questions, like arithmetic questions, during the interview. I think it's like pretty old fashioned. They're just trying to see how you perform under stress. Pretty much, it's like, say all the systems are broken. Like how do you make sure you don't lose money? So it's like that's not really an important part of the day to day job in most firms. They're just like asking that to see if you
Mm.
have a mathematical brain and like you can work under pressure.
Got it. And I actually spoke with a hedge fund investor who worked on the more fundamental side, and then something that he said was when we make trades or investments and we don't have there's too much noise or something like that, then they just simply just pull out of the investment altogether. When it comes to something that's systematic and you guys are building these models and there's black swan events where if you guys pull out all the way, then there's an opportunity that you could miss, and then and on the flip side, of course, you could lose a lot of money. So when everything is set up systematically, how do you build your models so that it takes advantage of like black swan events as opposed to like having you guys lose a lot of money?
Yeah, sure. I mean, there's like black swans and then there's black swans. That's the first thing. So like generally, most systematic trading strategies, like especially high frequency ones that like these prop shops do, basically like Optiva, Jane Street, these guys, Hudson River, generally tend to make a lot more money in high volatility markets. The reason for that is they tend to be quite risk neutral. So if the market moves one way or the other in like big moves, they don't really get affected. And what they're able to do is they're able to trade against people like the guy you just interviewed, right? Like your friend, he basically said, oh, if market moves too fast, we pull out of the market. When they pull out of the market, they actually trade to get out of the market. And when the market is volatile, that's like the worst time to trade because the transaction costs are highest. The spreads are the widest, basically, when the market is volatile. And generally, like prop or quant trading firm strategies take advantage of these wide spreads by offering liquidity on the other side. So just like by the nature of like these short-term trading strategies, the high-frequency trading strategies, they generally tend to make more money during volatility, and that's because they don't have as much directional risk. If you're like a very long-term investor, you're like at the whim of the market. Basically, it's like you said, if you buy a stock and it goes down 20%, like you can't just sell it. Like otherwise, you'll always lose money. Like you have to wait for it to go up. And like if you have that mindset, like oh my thesis or my signal isn't as good anymore, I'm just going to like pull out of the market. You generally end up pulling out at the worst possible time, which is the best possible time for these like quant firms. So almost always in like very high volatility events, quant firms do insanely well. So 2021 was like really the dawn of like these quant firms like doing really well during COVID. The first company I worked at, Flow Traders, I think the highest amount of money they ever made in a year was like around $300 million across the firm. And then during COVID, they made over $1 billion, like instantly. And like almost all of it was in like the first few months when COVID was announced, right?
Mhm.
So it's like the nature of the strategies that they generally tend to do well.
Hey, so we'll get back to talking to Annanay in a minute, but if you're watching this video because you're interested in a career in finance and investment banking, I wanted to tell you about my mentorship program, the Banking Accelerator. Banking recruiting has gotten insanely competitive. Banks are hiring undergrads earlier than ever before, and top firms now have sub 1% acceptance rates. I constantly see candidates memorizing the same technical guides, sending hundreds of generic LinkedIn messages that disappear into the void, and honestly just a lot of time being wasted by them. The students who actually land offers understand how banking recruiting really works. They know how to position their background properly, send messages that bankers actually respond to, and they learn technicals the right way with Excel modeling, which I think is the most efficient way. This is what we teach in the Banking Accelerator. You get one-on-one coaching, weekly calls with me, guest sessions with bankers and investors, over 30 hours of video content, and a complete system for the entire banking recruiting process. If you're serious about banking recruiting and want to see if this program is a good fit for your situation, then feel free to check out the link in the description to book a call with my team. We'll walk you through exactly how the program works and whether it makes sense for you or not. With that said, that's all from me. Let's go back into the interview.
So then, like on the more infamous sides, there's always the high frequency trading companies that or firms that when there are these kinds of like black swan events, or maybe it's something else that's just broken in their systems, that there's like a huge glitch and technical glitches or something like that that costs the firm's money. Have you seen things like that as well? And if so, like what do you feel like is really the cause of those kind of quote unquote glitches? Like that's what it's portrayed in the media, but it sounds like there's probably a lot more to it.
Yeah, it's usually just bad software practices. I would say I'm very lucky. Like I've never been in a scenario where I've seen an algorithm lose like a lot of money because of some algorithmic error. It was like usually some human turned it on when it shouldn't have been turned on. The most famous blow up is a company called KCG, Knight Capital Group. They turned on. It's basically as usual. There's like a cascading series of errors, right? So like there was some bad software practices where they like reused a flag in a strategy for like a different purpose than the original purpose. Then somebody deployed it in the wrong way, so it pointed to the wrong code base. Then somebody turned the strategy on at the wrong time. It shouldn't have been on at the time. And then there was like this general risk management failure where like basically everyone could see it was losing a load of money, but like the quant who made it like wasn't in at that time or something when they turned it on. So like nobody wanted to turn it off because they're like, oh, maybe it's just like a glitch in the reporting. It's not actually losing that much money. And then like before I knew it, the entire firm was bankrupt, right? So like this is so it's usually not just like a single bug. I would say firms are generally like very scared of these tail events like blowing up the entire firm. So yeah, I mean it's pretty good. Like I feel modern software engineering, not just in the trading world, but like generally in the DevOps world and like creating highly reliable 24/7 systems, like all those best practices have been fed down, and like the way these systems work, they're all on these best practices, and like it's pretty hard for them to like do something that bad. There's like many layers of things that would have to go wrong, including the exchange side, by the way. Like not even the trading firm side, like the exchange would warn people as well, and their broker.
Then on the flip side, I think you kind of alluded to it a little bit, but when you guys are building your models and you're trying to create changes that will actually help you guys make returns, then what is it at what point, or how does that process like look like? Like is it a small pilot first with like a small amount of money and you scale it up, or and how much like collaboration is there with like more senior traders and all that? Like what is it, what does something need to get to for you guys to actually implement a change?
Yeah, it depends on the market. So some markets you have like very good back tests available. So and the back test is like, it's not like a hack. It's like pretty much you can plug the strategy into like a pseudo exchange that is, as far as the strategy knows, it's like basically just talking to like another exchange, right? And it's like getting the same data that we've got in the back, like in the trial period, and then you just look at how much money it would make then, and you can use those to set certain parameters that can't be deduced statistically. For less liquid markets, it's like harder to do, And in that case, yeah, there's basically, you would start off at a very small size and you would use it to collect data, and you can do some statistical techniques on the data that it would collect, the way it trades, both in terms of how much money the strategy is making, but also like what the latency of the orders are, like how frequently it, like how much risk it tends to hold, how directly exposed just to risk, and all these things, and basically work through those. And then it goes through like gradual phases of like increasing size. Basically, you just keep like turning up the size as long as it continues to do well. And unless you're almost all strategies that are compliant and aren't like market manipulation tend to do worse with bigger size. So you have to you find this like tail off basically of like you try and measure how much money the strategy is making per dollar that it trades, and eventually it kind of tails off. And if you keep pushing the size bigger and bigger, it'll actually go down for like various technical reasons I can maybe explain later, but they're quite involved. And yeah, that was what was very interesting actually about the whole Jane Street thing and like their options trading strategies in India. The reason a lot of people said actually this is like a very cast iron example of market manipulation is just that those strategies seem to do better the biggest sizes that they traded. And there is like no example in the world of a trading strategy that does better, which isn't, market manipulation, that does better the more size it trades. So that was like a smoking gun. A lot of people said that this is kind of an example of manipulation.
And then when it comes to having an edge in high frequency trading, is it more about like how quickly your trades are, or how sophisticated your models are, or the people who are actually building it, what their market intuition is? Like, what do you think really creates more of an edge in the industry?
Yeah, I mean, to have an edge, there's like one of two things. You either need to have like a business edge, or you need to have like a quant edge, right? So quant edge is hard, right? Like, and the reason is the clue is really in the word edge, right? So what is edge? Edge is what you can do better than your next best competitor, right? And unfortunately, there are a lot of very smart quants out there. I would say like, I was not like, in the top 5 quants that I know of personally, right? Like I know a lot of very smart people. I'm very lucky to do that. But there are a lot of IMO medal winners in quant, right? So to have an edge in quant is very difficult, and it's a very collaborative process. Like the company has to be set up in a way that a lot of smart people can usefully all work on different aspects of the same system and together make it like better. So modeling, stats, that kind of stuff is definitely a source of edge. It's very hard to do. A lot of companies are very good at it. Citadel Securities and Hudson River and XTX, these kinds of firms, like really, really good at that side. Then other edge is just like business edge. So it's like, can I trade on a market that no one else can trade at? Or can I trade on a market for lower fees than anyone else can trade at, which is like a huge edge, because then they have to they have to tune their strategies to make more dollars per trade than you do, because say you can trade for 0 fees and they have to pay 1 cent for every dollar they trade. It's going to be very hard for them to make money, because all of those smaller opportunities to make money, you're going to sweep up because they are unprofitable for them, but they're profitable for you. So, I would say the best companies that make a lot of money, most of their edge is just like on the business side. And it's in their ability to transact in large volumes and get very good deals from the exchanges that they transact on, rather than necessarily just having the best models. So there's some markets where it's like more important. So usually in crypto is like very democratized, for example. So like crypto, like pretty much anyone can just like turn up and connect to the exchange API and start trading. So there it's kind of hard to have a business edge, but people do. A market like FX is like very business focused, because FX exchanges, you actually have to source the customers that you're going to trade with. So if you can source people who are like less sophisticated and trade against them, then you have a lot of edge, because other people may not be able to source those people. So that edge is really in sales, and that's why actually banks still dominate the FX trading world even more than high frequency trading firms. The rest of equities and stuff has moved to HFT domain, but FX is still dominated actually by the big Wall Street banks.
And when it comes to high frequency trading versus like fundamental hedge fund investors, like, do you think that their two strategies are so different and separate that there's room for both? Or do you feel like quant traders are kind of taking all the alpha more and more?
Yeah, it's really interesting. It's basically the question you're asking boils down to, is it's easier to predict the market, or for a machine learning model, right? Or like even an AI model nowadays, we have like an AI models as well. For some kind of statistical model, is it easier to predict the market 5 seconds ahead or 5 years ahead? And the answer is always 5 seconds ahead, right? It's very, very, very hard to predict using statistics something 5 years ahead, because basically the statistics can't account for a bunch of things which are very hard to account for. Like, I can already tell you to predict US equities in 4 years' time, the number one thing you need to be looking at is who will win the presidential election in 3 years, right? That will like have a huge impact on what US equities will be in 4 years' time, right? So statistical models can't really predict that. It's like very, very hard. Or like another way to put it is they're not really trained on the kind of data to do that, right? So most of these high frequency trading firms, they just use like price data from the order book and the exchanges. They don't look at like opinion polls of like how popular Trump is, right? And like whether, or like the probability that he's going to change the constitution, give himself a third term, right? Those are the things you need to think about as a long-term investor. It's much more kind of thesis driven. And models basically are just useless at looking that far ahead. Another kind of more mathematical reason for it is like, to train a model, you need to give it data points, right? Now, say to train my model, I need 1,000,000 data points, right? If I train a model that just looks 5 seconds ahead, right? Very crude, but I need to do 1,000,000 times 5 seconds. I need that much of data. If I want to train a 1,000,000 point model on something that looks 4 years ahead, I need 1,000,000 times 4 years. So you just need to look back way further, and like data might not even be available that far back. So very different statistical problems. It's basically very hard to do statistics that far out mathematically, and like the things that matter for predicting stuff that far ahead, just like aren't in the models that are currently used by quant firms. So with that said, I will say there's a general trend by quant firms to move into longer and longer term horizon predictive models and trade on longer term horizons. I don't think they're going to get to the stage where they're picking off like multi-year hedge funds or anything like that. For the reasons I just described, right? Like they're processing different data, so the edge is different, and the way you build those models mathematically, you just like you don't have access to the kind of data that you need. So then, the two will exist side by side, basically.
Got it. So you don't think that there will be I guess like people from the outside looking in, when they hear like AI is coming in, or like these quant traders are coming in and they're gonna totally make the fundamental hedge fund industry kind of like useless, or they'll lose their edge. So you don't really think that that's the case per se. They're quite different.
I mean, I would say like AI could be used in fundamental hedge funds in a massive way. I just don't think that it's going to be the current quant firms to do it, because they are not actually. I mean, quant firms are probably less AI native than fundamental hedge funds right now, right? Because the way quant firms operate, they don't use LLMs, right? Like to make a statistical prediction, like if you ask ChatGPT, like, hey, here's the last 3 months of Tesla prices at like a microsecond level detail, tell me what Tesla's going to be in 5 seconds, ChatGPT will be useless, right? And the reason is you have to feed the model with like your understanding and intuition of the market in order to get it to do that prediction very precisely, right? You have to constrain the model a lot. It would be like, it's just like using the wrong tool for the wrong job, right? Or it's like using a Swiss Army knife to butcher a cow, right? Like there are a lot of tools in the Swiss Army knife. The Swiss Army knife is like an LLM, but to butcher the cow, you just need one type of knife, right? And like that's the only one that'll do. And if you use anything else, it's like useless. There's like a very good argument for saying like these fundamental hedge funds, like the analysts are already using LLMs in a big way to get data that they wouldn't otherwise have access to and present it to themselves. Maybe they're using LLMs to even like they're getting all the data sources. They're asking LLMs to summarize them, and even asking LLMs to produce a prediction. That could definitely happen. But I would say the fundamental hedge fund guys who kind of know what data is important and what works already are more likely to be able to engineer these LLMs to make fundamental long-term predictions, and they know which news data to pull, for example, than the current quant firms. Like those guys just work with numbers. They don't work with theses. They don't work with news headlines. They don't work with like political events, right? So they're from two very different worlds. And even though the hedge fund guys are maybe less technical, you don't have to be super technical to use LLMs nowadays, right? Like you just have to prompt them very well. Yeah.
Oh, that's interesting, because I thought I had read that there were, I forget which firm was, but it was a quant one. Dang, I forgot the name. But then I thought that they were like training their own AI models, and they were a quant firm. But are you saying that just requires a ton of resources and only a select number of firms can do that, or you think AI, at least at its...
I think financial journalists make headlines which are designed to like clickbait people in, right? Like no like high frequency trading firm is using LLMs in production to trade. That I can tell you is a fact, like for sure. They could be using LLMs as part of the process, maybe asking it to come up with new ways of predicting the market and then testing them themselves. Or there could be quant firms. I mean, there are types of like quantamental firms that, like, for example, do sentiment analysis on Reddit, for example, right? Or sentiment analysis across like news sources. And they say, okay, like, you know, we can't as humans read 10,000 analyst reports on Tesla, but I'm going to get, so, you know, NLP, which was like the precursor of LLMs, I guess, was like, had algorithms for saying, okay, here are like 100 words I associated with stock doing well, 100 words that associated with stock not doing well. But, you know, if I have the word not in front of one of these words, it flips it. So like, how do I algorithmically search through all these analyst reports and figure out their net score, and how do I combine those scores? That kind of work might be better done by LLM now. So those, yeah, in those scenarios, maybe. But quant, like, when people think quant firms and they think like Optiva and Jane Street, like they're not doing that kind of stuff. That's for sure.
Got it. Okay. And then one of the questions that people always are curious about is like how comp looks like when you're kind of more junior on the trading side, and how it kind of goes up and what the structure is like. Can you give us some insight into that?
Yeah, sure. So I think like grad comp is typically, there's like a signing bonus, a base salary, and like a guaranteed bonus, which is like the anchor for your future comp. Your aim really as a trader is to get a percentage cut of the P&L you generate. That's when you know you've made it as a trader. It's like you get a cut. So if you're good and you stay at a firm for like, yeah, I mean, if you're exceptional, you can do it faster. But like, you know, a good trader at most firms should be able to get to the stage where they can negotiate a percentage of P&L they generate within like 5 years. Again, if the firm is like not great or you're exceptional, it could be less. Some firms just like never do it ever. Some firms actually do it like by rule. So Optiva has a system called marbles, right? Where like each marble represents like a share in some shared bonus pool. And the number of marbles you get basically scales with your seniority in the company. So they have like a very formulaic way of doing it.
These are metaphorical marbles, right? Not like real.
They're not real, no. They're like I don't know, like I think a junior Optiva starts like 100 marbles or something, or like they start on 0 and then they get 100 and they get to 200 and they get to 400.
Interesting.
And then yeah, it's like you add up all the marbles earned by everyone in the company, and then like your number of marbles divided by the sum of is like your share in like the bonus pool for that year or something. So they have like a formula for everyone actually. And yeah, the interesting thing about trading is like, because you can kind of get into this formulaic world, and because in theory you can make like infinite money, and you can only lose finite money, right? They can't take money away from you for losing money. You can like theoretically do very well. Like the best guy from my graduating class at Cambridge, 3 years into his job, was paid 5 million. So that's in London, by the way. London is like, you know, London's low salaries in general. But you know, like even I mean, to get into quant, you still had to be like amongst the top in the class, and the median quant is still like making nowhere near that. So it's very top heavy, very tail skewed. And what excites people is the opportunity to make like ridiculous life changing sums of money. It is changing a bit. I feel like my grad class, you know, the way we thought about it, we were like much more risk on, and I feel like the post-COVID grad classes are more like, you know, they kind of see it as a salary and like a normal corporate job, and they don't think about the upside anymore. You know, and accordingly, comp structures have shifted. Like companies like Jane Street were like hiring a lot of grads recently. They used to hire a lot less when I was recruiting. And those guys, if you got hired by Jane Street when I was recruiting, it was like insane. You were like unbelievably smart, especially in London. Now it's like, you know, you still have to be smart, but you don't have to be like ridiculous. Like kind of more normal people can do it. And accordingly, the comp structure has kind of shifted to like these junior guys who want relatively high bases, but will probably never make it like really big. Whereas like 5, 10 years ago, whatever, you had the opportunity to make it really big. So I mean, quant as a career is becoming commoditized, right? Like the secret's out. It's it's no longer like the elusive thing that it used to be. They're no longer like very small shops. Most of the shops have realized that like they can kind of move into the business that banks is doing, which is a bit more labor intensive, and start making more money that way. Whereas historically they would only hire like the absolute best and just try and make as much money as possible per head. Now they're trying to just make as much money as possible, even though the standard is lower. So definitely a little easier to get a job nowadays in quant, and like that extreme upside is not there, but like obviously it's still like very, very highly paid.
And then, so did you ever notice like the personalities of the people you worked with? Anything in particular that makes you think that these kinds of personalities fit well with, besides just being smart, like the personalities that work well for the industry?
Yeah, people who are competitive, aggressive, very detail oriented, like solving hard problems. I think like in trading or quant, you can never really like brush any problem under the carpet. Anything you brush under the carpet, somebody can exploit from you in the market and make money off you. So yeah, just like typical math student personality, I would say. That's why like they love hiring mathematicians, right? Like all these firms. I would say and probably not missed anything. Each firm does have its own culture, which is like important to notice. Some people have like a very openly aggressive culture. Some companies like don't. They're like actually much more intellectual and cerebral, so that's part of it. But uniformly people are competitive and they like to win, and they're motivated by money. And they like solving hard problems.
Got it. And now it's kind of like you're trying to solve one of the largest problems by like being an entrepreneur and founding your own business. That's like one of the hardest things to do. And I wanted to first ask and go into a bit more of like, when you decided to start leaving the firm, like what was that process like in your head? And then what made you finally pull the trigger?
Yeah, look, for me, it was like I had this idea. It was based on, I'm making an exchange, right? QFEX is an exchange. And at Tower, I was very lucky to join one of the most successful crypto teams that existed at the time. And I joined the team. I did. We did pretty well. That unfortunately, Tower went into a lawsuit, which is public knowledge, and we had to stop trading crypto. Right, so I had to stop trading crypto. And then I moved into other asset classes, and I noticed that the exchanges were very different in those asset classes. Like the way the exchange was structured was like completely different. The way they kind of consumed and sent orders was different. The kind of access they had was different. And for me, the calculation was like, okay, I have this idea. I think I have a lot of edge. So I thought about it a lot like a trader. I was like, I think I have a lot of edge because I don't think many people in the world could build this. I had a unique perspective knowing that, very few people thought about doing this crypto style exchange on traditional assets, like what we're doing basically, like equities and commodities. So I was like, okay, I have some edge in doing this. And then it was like a risk reward decision for me. So I could continue to stay in my job and get paid pretty well. Or I could try this and get paid like really well. And like, if things don't turn out, like, it doesn't matter. I've still done pretty well in life and I can always go back. And then, I think that kind of expected value risk reward thinking was mostly it. And then like a bunch of other things fell into play. So my co-founder, I knew he'd be a very good co-founder. He left his job at Citadel around the same time. And he was like very entrepreneurial. I knew like, we would work well together. And that's one of the hardest things about starting companies, finding like a guy who's as committed as you to work as hard as you to do it. And then, Trump got elected. So I thought, probably quite a business friendly environment coming up in the US. So that was like another win. And then, we also like applied to YC pretty early before we even had any code written. We got in immediately. So I was like, okay, well, we already got funded. Like we've already got off the ground, which is like the hardest part. So I was like, okay, let's just do it. Yeah.
And what was the YC portion like? Did you guys just have to create like a presentation or something and go in front of a bunch of investors, and were there like multiple rounds and stuff? Or I haven't actually spoken with someone who's gone through the YC process.
Yeah, it's actually a very streamlined process. You just fill out one application form, and then if you get invited to interview, you get invited to an interview, and then it's like a 10-minute interview. The partners are really good. They know exactly what they're not experts in your thing. They know exactly what kinds of questions they should be asking to figure out if you are an expert in your thing and you've thought about it. And then you get a decision within a day. So it is very fast, and by making it fast, they're able to handle a high volume of applications, I think. That was pretty much it. It was one application form and one interview.
One 10-minute interview.
Yeah.
That's pretty insane. What were some of like the questions that they asked that makes you think like, oh, they know how to ask the right questions?
They usually ask some like very generic questions at the beginning, like why has no one built this yet? Why you tell me what you're building? Like they try and catch. They have it in their head. There's like only if you watch YC's videos, they have this YouTube series called Startup School, and they basically axiomatically figure out like business for you, right? So it's like, okay, there's only like 8 valid business models that exist in the world, and they have in your head, right? Okay, you guys are a marketplace. You're targeted towards consumer. They enter this decision tree, and then they kind of know which questions they ask you, right? So it's like, what do the unit economics of this thing look like? Why has no one built this before? What's like the total size of the market that you could hit? Who are your competitors? What are some similar companies out there that you can kind of comp the growth path of your company to? And then, depending on your responses, obviously they like grill you more into that. So we kind of had to explain how our product works, and he was like, "Oh, okay." Like, we were like, "Okay, it's more efficient, more capital efficient, this crypto type of exchange than this exchange because of this reason." They were like, "Oh, but why not just do it this way? This is how Robinhood does it." And I was like, "Oh, yes, that's very different, but here's the reason why it's better." And you being able to explain that well is also like a good sign, basically, because it means that you have clarity of thought and you've understood what you're doing.
Can you actually go a little bit more into QFEX and explain what the key differences are between that and say Robinhood or something?
Yeah, so QFEX is the first 24/7 perps exchange for equities and commodities. I'll break that down. So basically, we went into QFEX wanting to make a crypto-esque user experience and capital efficiency for traditional financial markets. So concretely, what that means is we give people unintermediated trading. That means that they can trade peer-to-peer against each other on exchange. If you look at what Robinhood does, Robinhood is not an exchange. Robinhood takes your orders and usually just sells them to some trading firm or like puts them in an exchange. And it's very unclear what price you're going to get. And it's also very unclear who you're trading against. Most of the time, you're trading actually against Citadel Securities, and they're just smarter than you, and they're going to make money. You don't really have a shot at making money because you have no shot at matching against another retail person like you who's just as informed as you, right? They don't have these fancy quants and these models. And that's something crypto exchanges do. And that's why a lot of people who trade crypto have made a lot of money. It's because the markets are fairer. And the other things that we offer much higher leverages because we're more capital efficient than kind of Robinhood is able to offer. They're much more intermediated, and like the way leverage works on those is like very different to how we do it. And we're also 24/7, so we're going to be the first place to trade equities over the weekend, which is going to be like a huge innovation. And like there's like an aftermarket, but it's not very liquid. There's kind of like a dead zone in the nighttime when like no markets are open on US equities. So we will have equities 24/7. Instantly settled, real time, basically, and we're going to be the first one ever to do that.
How does that work? Because there's like the price of a stock, and there's a bit of a spread. But how do you trade back and forth with it when every other exchange in the world, like let's say Nvidia's at like $180 everywhere else, and people are trading on your platform, and it goes up to like 190? How does that discrepancy settle ultimately?
Yeah, ultimately it's the market makers, right? So we are an exchange. We don't actually trade against our own customers. That's like very important to know. So people can trade, and when they do, they either trade against each other, retail. They trade against some firms who basically add liquidity to the market. If the price of, say, the market was open and Nvidia or Tesla or whatever moved up $10, market makers or like basically if people didn't move their price up $10 on QFEX, somebody could buy from them on QFEX and then sell on, say, NYSE, New York Stock Exchange, or NASDAQ, and then capture that difference as an arbitrage, basically. So to avoid losing money, people generally move their prices up, and that's how all markets stay in line. Is like if there's like a price discrepancy between two places, arbitrageurs will buy in the cheap place and sell the more expensive place, and that pushes the prices basically back in line. Where the cheap place, there's a lot of buying pressure, so supply and demand, price moves up. And in the more expensive place, there's a lot of selling pressure, so supply and demand, price moves down, and the prices converge basically.
Okay, so I guess I was asking more about, but I think I understand what you're saying then, because right now it's really, you can't really trade too much after hours or on the weekends, and so but the price changes are very minimal. So I'm guessing what you're saying is that on QFEX you can still trade after hours on the weekends, but you won't have large swings, but you can still trade. Is that right?
Yeah. So I mean, after hours on the weekend is like a separate problem. So it's like, so while the underlying market is open, our price needs to be in line with the underlying market. When the underlying market is closed, say New York Stock Exchange is closed, we are the market, right? So if the price on QFEX moves up $10 from the last close on New York Stock Exchange, that is the real price of Tesla, because nowhere else is open. We are the market now. Now, if there's a discrepancy, one of two things will happen. Either the price on QFEX will go down into the next open of the New York Stock Exchange, or the New York Stock Exchange will actually open up and be at the QFEX price. And or something in the middle will happen, the prices will converge in the middle at the time of the next open. And if that doesn't happen, people can make arbitrage profits, so they will push it back in line anyway.
Okay, got it. That's interesting. Yeah, I didn't fully understand how that works, so that's cool. And so I also wanted to understand, if you find this work a lot more fulfilling, like, are you enjoying it a lot more than trading? How's working on your own business felt for you?
It's really interesting because it's like the opposite of trading, in that in trading you become an expert at one thing and you just do one thing really, really, really well, and that's the only way to get edge in trading. Like to win at trading, you have to do at least one thing the best in the world, right? And if you're not the best in the world, like you won't make any money. And in order to do that, you have to get really hyper specialized at one thing, right? It's like when I was trading commodity futures in my first job, I got really good at trading that one commodity future. I understood that market really well. Running a business is like very different though. Like you have to be pretty good at everything, and like ideally very good at everything, right? So there's you can like lose in a lot of ways, right? And you have to make sure you don't lose in those ways. And those lots of ways can be growth, engineering, dealing with lawyers, dealing with like your bank. There's so many different aspects of running a business, and a lot of times you don't really have time to become an expert in that thing. So you just have to do your best. And it's a very different mindset to, only do something if you're the best, to, hey, just like give it a go. And if it doesn't work out, it doesn't work out. But you have no option but to try and do this thing now. So yeah, it's been very good opportunity for growth. I've had to think in many different ways, and my job description keeps changing every 2 months. When we first started, I was just coding 24/7. And now I haven't written any code for 3 months. And, I'm like writing articles, or I'm posting on social media, or like I'm figuring out, what people want to trade. And then my co-founder is also kind of moving away from coding, and like, he's thinking about what the UX and the design of the product should look like. So, I would say those are kind of the two things. One is like your job description keeps changing, and the other is like you end up having to do a lot of things which like you only learned the day before, and like you just have to make do with whatever knowledge you have.
Right. And what kind of lessons have you been able to bring from the trading world into the kind of founder or startup world?
Yeah, I would say, I think about business very much like a trader would, right? So I would say a lot of like the typical Silicon Valley founder, let's say, is like, views money as this like thing they don't need to care about. They can just keep raising more. They just want to make something like huge. They hate the idea of working at like a big company. I try and think about like, to win in business, like you have to do something better than everyone else, right? And you have to give some people something that they want, but you also have to give them something that's better than your competitors. And like if you build a business that's worth building, you're gonna have competitors because like ideas are very cheap, right? Like one of our partners at Y Combinator, Tom Blomfield, he founded a bank which now has like 10 or 15% market share in the UK, like nuts, right? And it was the first app-based bank in the UK. So you could do everything through your app. You could send money, receive money, track your transactions, everything. And he told us, he was like, like this only became possible because like the UK government changed the banking API around the time we started building it. There were like 10 other guys trying to do the same thing. Like it was obvious someone was going to do this. And like the reason we won was like we did it better than everyone else. So from the trading world, I think a lot about edge. I think about, where can we win? Where does our team have expertise? Where do we need to bring in outside expertise, either as like outside counsel or like we need to hire someone else? And, I think we have a very good team, right? Like, so, I was at Tower as a quant. My co-founder was an engineer at Citadel. We have some of the best engineering talent, I think, in the world. We just hired someone from Jump Trading as a core developer. And we're about to hire someone from Hudson River Trading as a core developer soon as well. And that's our edge, right? It's like our team is some of the best in the world. And therefore, we are able to produce like a more cohesive, robust, and better trading experience for other people.
So how many people are at the firm now?
So we have 8 people now. Yeah, we're hiring. We should be about 10 or 11 by the end of the year for sure. We have a few roles hiring for.
I think I have heard before that something around the number of like once you get to like 13 or so, that's when you need to have like additional levels of management or something. Once it's from like 7, 8 people or something, that's kind of manageable as like a founder. But then once you get a little bit more and more, it gets really hard to do that. Like, are you finding yourself learning a lot about management as well?
Yeah, I would say so. You're right. There's very different. I think like PG popularized this in like his essay, founder mode, right? So he was like, big companies run manager mode and like startups run founder mode. So we're definitely like very much in founder mode at the moment. There's like an org chart we submit, right? But it's like everyone just sitting next to each other and like you can talk to anyone about anything. We definitely learned a lot of lessons about, how to hire, I think, and also how to set expectations for our employees, right? And like the great thing is we've hired really, really smart, very good people who are like very self-motivated as self-starters, so we don't have to manage them a lot. But the most important thing I've learned is like you can't hopefully ever as a founder kind of sit back and just rely on the people under you to like do everything, right? Like you always have to be in the details and the weeds. And I still like to think I have a deep understanding of all of the aspects of the exchange we're building at the moment. And I think 13 seems too low. Like I think even up to 13 people, like we'll definitely, me and Josh, my co-founder, will definitely both be deep in the weeds in all the detail of everything we do. And we hope to keep it that way for like as long as we can.
I've also heard from founders that when you are raising money and you're in that kind of fundraising cycle, it can kind of take up a lot of your time, and you're kind of like you're raising money and then you suddenly have to raise money again like a few months later. And I know that you've started raising money a bit too. Like, is there any truth to that, or were you guys able to raise and then kind of pause and work on stuff and then you focus on the next round later?
Yeah, I would say VCs like distract, if anything. I mean, like we finished our round in 3 days when we did our seed round, but it really varies for a lot of people, right? Like, unfortunately, raising money is like a game as much. It's quite orthogonal to running a good company. So I think probably due to my background as a trader, I was like fairly successful at this game, and we managed to get a very high valuation, close the run very quickly, and get back to work. I think a lot of people do struggle and they take weeks or even a month to like raise their seed round because the problem is if you don't have momentum at the beginning, later investors, especially at seed stage, it's like very hard to like have time to properly understand someone's business model and so on. So yeah, it's, especially at seed stage, a lot of investors just kind of rely on other investors doing due diligence, and they're like, oh, this famous investor has already invested, they must be going to do well, and like I'm sure a lot of other people want to put money into this. If I don't, I'm a fool, right? And if you struggle to create that momentum, then fundraising can drag on and be very time consuming. I mean, fundraising is a drag on time and a distraction, and yeah, I think we did a good job at getting it done as fast as possible.
So then, what are your tips for any founders listening here? Like, sounds like you were able to do like a sprint in raising in a few days. Like, what? I guess like at a certain point, also like your product or company also needs to be a really good idea. But was there anything that you did that allowed you to raise money so quickly?
So everything we're doing so far is for seed stage, I would say. So that's why we're talking about seed stage here, early stage or pre-seed stage fundraising. I would say team is like very important, because a lot of seed stage companies like do pivot, and then the investors are like they can't really pull their money out, right? Because they didn't invest in the idea, they invest in the team. Or the company, which is the founders, basically the directors of the company, the founders. So the team has to be very strong, and like I think the best advice I got given for fundraising was from Paul Graham, PG, and he was like, "Look, at seed stage, investors only really care about two things, right? And one is like, if these guys succeed, are they going to make a huge company? And huge, it has to be like at least 10 billion, right? Like at least, like, is there a probability, or like, is there a possibility this company is going to hit at least 10 billion valuation? And the second thing is, are these guys the team that has a greater than zero chance of doing it, right? So greater than zero, it can be tiny. There has to be some chance that you guys are the ones to do it, and it can be huge if it does succeed. If you look at seed stage venture returns, right? Like if you look at like an average VC, if they make 100 investments, like 90 are probably not going to return any money. They're probably going to die. So they're really looking at like a very small tail. You need to hit home runs, basically. You need like that one investment, which is going to like 100x or something. It's going to pay off the rest of the portfolio which died. Yeah, I mean, that's ultimately what they're looking for. Like it's basically I think a lot of founders get stuck, or a lot of CEOs, the ones who raise, get stuck saying like, hey, I have a good business model, I have a plan, I'm going to make like this much profit by this year. Like no one's interested in that. What they're interested in is, if this works, they're going to be massive, and do you have like the best team to do it? And honestly, if that investor likes your idea, they're probably going to try and fund all your competitors as well. But they want to make sure that they've funded the people that seem like the best to do it. And if the idea works out, they'll make a lot of money. Great. If it doesn't, they don't really care. Like seed stage investors don't really care about losing money, because like most of their investments lose money. What they get annoyed by is like, if you reach like a 200 mil valuation and then just stay there stagnantly, and then you're like not returning any money, but like, you were never going to hit like that 100 billion home run, and your base is good to them is dead. And that's, I wish more CEOs, I mean, from my trader background, it's like easy, but like, I wish more CEOs would go into fundraisers and think, what does the other guy want to hear, right? Like, what is the shape of the pitch, the shape of the bet that they want to make, and how do I help them realize that my company fits into that shape?
And when you have been working with, now you're in VC territory, I guess, and what I've heard from founders as well is that once you are VC backed, there's, check-ins you have to do, more pressure and all of that. Of course, the benefits are you have capital, you have support and all of that. But have you found that it's a lot more there's kind of like a ticking time clock in a sense, or do you have enough breathing room to kind of build your business? Like how do you feel about all that?
Yeah, I would say like at seed stage, terms tend to be very founder favorable. And as soon as you raise a Series A, then some of the balance shifts to the VC. It depends how you negotiate it. Our check-ins are all like completely optional. Like all my interaction that I do with investors is like completely optional at this stage, to be honest. So at this stage, there's like no pressure. Our investors are very good and very helpful, and they do help us a lot. I have asks of them, and they generally like try and help as much as they can with those asks. Even like the smaller angels who have like a very small share of the pie, they do help a lot. Yeah, I would say, talk to me again once we've raised the A, and my opinion might be different. Then there might be more pressure, but yeah, that's
okay.
At seed stage, things are still very founder friendly.
Cool. And then last question I had for you was, kind of related to QFEX and also personally for you. In let's say like 5 to 10 years, like where would you ideally want to be for the company and then also yourself?
Yeah, so we QFEX is very much a long-term play. because it's in like a regulated financial industry, and we're seeking regulation. And regulation takes time. It takes time to get licenses. It takes time to commit, ask regulators to give you permission to do crazy new things that they've never heard about. So, in 5 to 10 years, I think the best thing for QFEX would be, look, we are doing a lot of volume. Obviously, volume is like our main KPI, it's our main metric. I would want us to be integrated with like large retail brokerages like Robinhood, for example. If Robinhood offers QFEX products, QFEX perps on equities, they do 24/7 trading using QFEX products on equities. That would be like amazing for us. I would want, it's like tempting to say, this much valuation or this much, but like valuations only exist because VCs make valuations to invest at, right? So some of the best businesses in the world don't raise that much money because they just become profitable very quickly and they can use that profit to grow. So we don't have any targets like that. I think for us, the only thing we're focused on right now is volume, helping retail get a fairer trading experience, and trying to scale that as fast as possible. And we're willing to integrate with brokerages to do that. Like, we don't necessarily want to keep all of our clients from coming on our website. Like, if they want to trade through Robinhood, they should do that. If they want to trade through another brokerage, they should do that. I think that's where I see us in 5-10 years time, and then kind of broadening out to institutions from there as well. So, we trade traditional financial assets. A lot of banks, hedge funds, and so on do that. They don't trade crypto, but they'll trade stocks. So if we can get like big institutions to start trading them, that's also very interesting for us, I think.
And then what about more on the personal side? Do you have any like personal goals with the company or yourself that in 5 to 10 years you would love to see?
I'd love to still be in charge of the company. That's my only personal goal. I think it's like a slog, right? Running a company, and like a lot of people fall by the wayside, and there's a lot of investors out there who like only invest in founder-led companies, right? Because they're like, once you replace the founders with some anonymous managers, like things start to go downhill. I do think me and Josh are like the best place to lead the company, and I hope that we manage to keep enough of our sanity so we're still doing it in 10 years time. I think that would be like the biggest win for us.
Awesome. Cool. Well, we covered so much and went a little bit over a lot of time, but thanks so much for sharing all your insights. I think trading aspect, a lot of people have been requesting on the channel. And so super, I'm sure a lot of people are going to really enjoy this. And then also the part where you're working on your business. I love that it's really adjacent to what you did. And it sounds like a really fascinating business that I also want to dig into a bit more. So thanks so much for your time and sharing everything that you did today.
Yeah, amazing. Thanks for having me, Ben. And the questions were like really good, really thoughtful. So thanks for arranging those as well.
Awesome. All right. Okay. Thanks, Annanay.
Yes.
All right.
Bye.
All right, so that concludes this episode. Hope you all learned a lot. I personally found it super interesting because there aren't that many people I've spoken with in the quant trading industry, and this topic was super highly requested. Also, as a friendly reminder, if you're interested in a career in finance and investment banking, check out my mentorship program, the Banking Accelerator, in the description below so you can speak with my team. With that said, thank you all so much, as always, for joining, and hope to catch you all in the next episode.